The Federal Reserve's main interest rate is lower today than it was a year ago. So why does borrowing money still cost about the same as it did back then? That's the part of this week's news that doesn't line up. And it's worth sitting with, because the answer explains a stack of headlines that have felt confusing for a while now. Here's what happened. The Fed announced it's holding its benchmark rate steady, keeping the target range at 3.5 to 3.75%. No cut, no hike. Same setting as the last meeting. If you were waiting on that decision to change something in your monthly budget, it won't. Not this week. That slightly flat feeling of watching major economic news land and then looking at your accounts and seeing nothing move is a real thing, not a lapse in attention. The connection between what the Fed announces and what you actually pay is looser than most coverage lets on. So let's take it apart. Start with why the Fed sat still. Inflation is still running warmer than the Fed wants it. In its most recent policy report, the central bank put price growth at just over 4% across the previous 12 months. Its stated goal is roughly half that. So prices are still climbing faster than the target, which was the whole reason rates went up in the first place. At the same time, the job market hasn't cracked. Unemployment is still low by historical standards, layoffs haven't spiked, and households are still spending. That combination puts the Fed in a narrow spot. Cutting rates makes borrowing cheaper. Cheaper borrowing encourages spending, and more spending tends to push prices up. With inflation already above target, a cut risks feeding the thing they've been trying to cool. But the economy isn't weak enough to force their hand either. Nothing is visibly breaking. So they wait. The official phrasing for this is maintaining the target range, which is a remarkably formal way of saying, we're going to sit here and see what happens. Now, back to the contradiction we opened with. The rate the Fed actually controls is a very short-term rate. It's essentially what banks charge each other to lend overnight. That number moves other short-term borrowing costs almost immediately, which is why credit card rates and home equity lines tend to shift within a billing cycle or two of a Fed decision. Mortgages don't work that way. A 30-year mortgage is priced off the bond market, and specifically off the 10-year Treasury yield. When an investor buys a 10-year Treasury, they're making a bet about inflation and growth years into the future, not next month. If they think prices will keep rising over that stretch, they want a higher return to lock their money up that long. Mortgage rates then sit a fairly predictable distance above that yield. So the Fed can hold, or even cut, and mortgage rates can stay exactly where they are. Sometimes they move the opposite direction entirely. The last time the Fed started cutting, mortgage rates actually drifted up in the weeks that followed, because bond investors had already priced the cut in and then got nervous about inflation. Right now, the average 30-year mortgage is sitting around 6.5%. That number isn't waiting on the Fed's next meeting. It's waiting on what bond investors believe about the next decade. That's the answer. Two different markets running on two different clocks, and only one of them is in the room when the Fed votes. Once you see that split, the ripple effects sort themselves into two piles. The first pile moves with the Fed. Credit card rates are tied to the prime rate, which tracks the Fed's decision closely. So a hold means those rates hold too. Whatever you're paying in interest on a balance this month is roughly what you'll pay next month. Home equity lines and a lot of variable rate personal loans behave the same way. Savings sits in that same pile. And this is the quiet upside nobody puts in a headline. High-yield savings accounts and certificates of deposit also track short-term rates. When the Fed pauses at a relatively high setting, the return on cash stays high with it. For anyone with an emergency fund parked somewhere, a hold is genuinely better news than a cut would have been. The second pile moves with the bond market. Mortgages, obviously, refinancing. To a lesser degree, longer auto loans and the financing terms small businesses get on bigger purchases. These respond to inflation expectations and the shape of the Treasury market, and they can wander for months without the Fed touching anything. There's a slower ripple worth naming too. When borrowing stays expensive for developers and builders, fewer new units get started. Fewer units eventually means tighter supply, and tighter supply shows up in rent. That chain takes years to play out, which is exactly why it rarely gets covered. It's still one of the more consequential paths between a rate decision and a household's actual cost of living. Put it all together, and the picture is steadier than it is dramatic. Prices are still rising faster than anyone would like. Borrowing is still expensive on the long end. The job market is holding up, and the Fed has decided that the safest thing it can do right now is nothing at all. For most households, that means this week is a continuation, not a turning point. Your card rate is what it was. Your mortgage rate is what it was. Your savings yield is what it was. If you've been holding off on a decision because you were waiting for the Fed to make it easier, this decision didn't move the ground under you in either direction. So what's actually worth watching from here? The first thing is the 10-year Treasury yield. It's published daily and takes about a minute to look up. If you want an early read on where mortgage rates are heading, that yield will tell you more than any Fed headline will, because mortgage pricing follows it with a lag of days, not months. The second is the next inflation report. The Fed has been clear that price growth needs to come down meaningfully before it moves, so each new reading is effectively a vote on how long this pause lasts. A cooling number pulls the timeline forward. A hot one pushes it back. The third is the wording in the Fed's own statement at the next meeting. Small language changes matter more than people expect. When the description of the risks shifts, that's usually the first signal that a policy change is being set up, and it tends to show up in the statement before it shows up in a decision. There's more to unpack here as the next round of data comes out, and we'll be keeping an eye on all three. Here's the takeaway. The Fed holding steady isn't a story about something changing. It's a story about why so much financial news feels like it should affect you and then doesn't. The Fed sets one short-term rate. That rate has a direct line to your credit card and your savings account, and only a loose, delayed, occasionally backwards relationship with your mortgage. Knowing which of your costs sit on which side of that line is the difference between reading a rate headline and knowing what it actually means for you. Quick reminder. Everything we cover on Decoded Money is for educational purposes only. None of this is financial advice, and we're not licensed financial advisors. Before you make any money moves, do your own research and talk to someone who knows your specific situation. If this was useful, hit subscribe. We do this every week. That's the Decode for this week. We'll see you in the next one.